Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Yum China Holdings Inc. Annual Report. Yum China Holdings Inc. operates a diverse range of businesses and services in the People's Republic of China. At its core, the company owns and operates restaurants under various concepts, including KFC, Pizza Hut, Taco Bell, Lavazza, Little Sheep, and Huangjai Huang. These brands cater to different tastes and preferences, providing customers with a wide array of dining options. In addition to its restaurant operations, Yum China Holdings also offers online food delivery services, allowing customers to order their favorite meals from the comfort of their own homes. This convenient service has become increasingly popular in recent years, as more consumers turn to digital platforms for their daily needs. By providing both dine-in and takeout options, Yum China Holdings is well-positioned to meet the evolving demands of its customers. The company's portfolio of brands and services reflects its commitment to innovation and customer satisfaction. With a strong presence in the Chinese market, Yum China Holdings continues to expand its reach and offerings, solidifying its position as a leading player in the country's fast food industry. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what could cause Yum China's stock price to increase. Yum China's stock price has seen a slight increase in the past year due to several factors. One of the primary reasons is the company's strong brand portfolio, which includes KFC and Pizza Hut. The brands have maintained their popularity among Chinese consumers, contributing to the company's revenue growth. Additionally, Yum China's efforts to expand its digital presence through mobile ordering and delivery services have been successful, attracting a younger demographic and increasing sales. Another factor that has contributed to the stock price increase is the company's focus on improving operational efficiency and reducing costs. By streamlining its supply chain and implementing cost-saving measures, Yum China has been able to maintain profitability despite rising labor and food costs in China. Furthermore, the company's strategic partnerships with local companies have helped it tap into new markets and expand its reach. Lastly, the Chinese government's efforts to stimulate economic growth through infrastructure development and urbanization have created a favorable business environment for Yum China. The company has been able to capitalize on this trend by expanding its presence in key cities and investing in digital technologies that cater to changing consumer preferences. Overall, these factors have contributed to Yum China's stock price increase in the past year. Yum China Holdings, Inc. market capitalization of $147 billion is significantly larger than the average industry peer of roughly $6 billion. This shows that Yum China Holdings, Inc. holds a significant advantage in their industry. Yum China Holdings, Inc. trades at a higher price-to-earnings ratio of 21 times, and a higher price-to-book ratio of 3.45 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company maintains a moderate leverage profile, with liabilities making up 42% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has consistently reduced its share count while revenue has grown, but declining assets and equity suggest buybacks may be taking precedence over reinvestment. The company have a dividend yield of 2.21%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. The primary drivers of revenue growth for a company can be attributed to several key factors. Firstly, an increase in total system sales by 4% is a significant contributor to revenue growth. Additionally, delivery sales have seen a substantial rise of 25%, indicating a growing demand for convenience and online ordering services. Another crucial factor is the growth in company sales, which has increased by 5% compared to the previous year. Furthermore, franchise fees and income have also seen an upward trend, with an 11% increase in 2025 compared to 2024 and a 17% increase in 2025 compared to 2023. The expansion of KFC stores in China, with over 12,997 restaurants operating, and Pizza Hut stores in China, with over 4,168 restaurants operating, has also contributed significantly to revenue growth. The company's focus on geographic expansion, increasing its footprint in existing and new cities, is another key driver of revenue growth. In terms of unit count, there has been an increase in both company-owned and franchisee units, with a 21% rise in franchisees. While same-store sales growth has seen a slight decline to 1%, the overall trend indicates a positive direction for revenue growth. Net income and profit margins of a company underwent significant changes between 2023 and 2025. In 2023, net income was $827 million, which increased by 2.1% to $911 million in 2024. However, there are discrepancies in the numbers, with some sources citing $980 million for 2024. Despite this inconsistency, it is clear that net income continued to rise, increasing by 12.6% from 2024 to 2025. Profit margins also experienced growth during this period. The operating profit margin, OPM, rose from an unavailable rate in 2023 to 10.3% in 2024, and further increased to 10.9% in 2025. Similarly, the net income margin grew by 0.6 percentage points from 2023 to 2024, and remained steady at 7.9% in 2025. The increase in both net income and profit margins can be attributed to various factors, including improved operational efficiency, increased revenue, or strategic business decisions made by the company's management. Despite some discrepancies in the numbers, the overall trend suggests a positive financial performance for the company over this period. The company's financial performance indicates a consistent generation of positive operating cash flow. The data from various pages of the report confirms this trend. On page 10, we see that the company generated $1,466 million in operating cash flow for 2025, followed by $1,419 million in 2024 and $1,473 million in 2023. Furthermore, on page 32, it is noted that operating cash flows from operating leases are greater than operating lease costs in all 3 years. This suggests that the company's leasing activities are contributing positively to its overall cash flow. Additionally, on page 50, we find that net cash provided by operating activities is positive in all 3 years, with amounts of $1,019 million, $1,659 million, and $14 million. Finally, on page 76, it is explicitly stated that the company's net cash provided by operating activities was $1,466 million in 2025. This reinforces the conclusion that the company is indeed generating positive operating cash flow. The company's debt level and interest expenses have undergone significant changes between 2024 and 2025. In terms of debt level, the total debt has increased from not comparable to RMB 10,495 million, $1,502 million in 2025. However, there are some decreases noted in specific areas such as outstanding short-term bank borrowings, fixed income debt securities, and long-term bank deposits and notes. On a more positive note, interest expenses have decreased significantly across various categories. Interest expenses have dropped from $4 in 2024 to $0 in 2025, while interest on lease liabilities has decreased from $3 to $2. Additionally, interest expenses, interest income, net, have decreased from $43 in 2024 to $22 in 2025. Overall, the company's debt level has increased, but with a decrease in specific areas. Meanwhile, interest expenses have seen significant reductions across various categories. The performance of various segments and regions within the company can be analyzed based on their operating profits. KFC and Pizza Hut are performing well, with strong loyalty programs that have resulted in estimated value of points earned by members being recorded as a reduction of revenue. This indicates a high level of customer retention and satisfaction. In terms of financial performance, KFC's operating profit has increased from $1,192 in 2024 to $1,206 $285 in 2025, while Pizza Hut's operating profit has also seen an increase from $153 in 2024 to $183 in 2025. On the other hand, all other segments are performing poorly. These segments have reported significant operating losses of $177 in 2025 and $168 in 2024. Additionally, their franchise agreements range from 3-10 years, indicating some variation in performance. Huangjai is also a segment that is performing poorly, with similar issues related to franchise agreements. The disparity in performance between these segments highlights the need for targeted strategies to improve operations and increase profitability. By analyzing the strengths of KFC and Pizza Hut, the company can identify best practices to implement across other segments. Conversely, by understanding the challenges faced by all other segments and Huangjai, the company can develop tailored solutions to address their specific needs and improve overall performance. Management's outlook on the company's strategy is one of expansion and growth. The company sees significant opportunities to expand within China, with plans to increase its geographic footprint in both existing and new cities. This expansion is expected to drive revenue growth through operating restaurant concepts. To achieve these goals, management will focus on improving system sales growth by increasing same-store sales and net unit growth. Additionally, the company will continue to monitor regulatory developments related to tax rates and plan accordingly. Capital expenditures are expected to be in the range of $600 million to $700 million for fiscal year 2026. Overall, the company's strategy is centered around expanding its presence in China and growing revenue through operating restaurant concepts. By focusing on system sales growth and improving operational efficiency, management aims to drive long-term success and profitability. The company has made several acquisitions and divestitures over the years, which have significantly impacted its business operations. In terms of acquisitions, the company has acquired various brands and assets, including KFC, Pizza Hut, Huangjai, and Lavazza. Additionally, it purchased Meituan's ordinary shares in September 2018 for $74 million. Furthermore, the company owns 2 company-owned restaurants and 2 franchisee restaurants. On the other hand, the company has also made several divestitures, including selling its company-owned restaurants, 329, and franchisee restaurants, 45. It also sold approximately 4.2 million of its ordinary shares of Meituan in the second quarter of 2020 for around $54 million. The company has a history of returning value to its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has consistently paid out significant amounts, with cash payouts totaling $248 million in 2023 and projected to increase to $353 million by 2025. This demonstrates a commitment to rewarding investors for their loyalty. In addition to dividend payments, the company has also engaged in share buybacks, repurchasing 24.7 million shares worth $1,136 million in 2025 alone. This strategic move not only boosts shareholder value, but also reduces the outstanding share count, potentially leading to increased earnings per share and a more stable stock price. Concerns have been raised regarding inventory buildup and potential disruptions to the supply chain. A specific instance of this concern is highlighted on page 20, where detailed analysis reveals a significant accumulation of stock that could lead to inefficiencies in distribution and delivery processes. This buildup may be attributed to various factors, including overproduction, inefficient logistics, or changes in consumer demand. The implications of inventory buildup are far-reaching, with potential consequences for businesses and the economy as a whole. Excessive inventory can result in wasted resources, increased storage costs, and reduced cash flow. Furthermore, it can also lead to supply chain disruptions, causing delays and affecting customer satisfaction. To mitigate these risks, companies must implement effective inventory management strategies, including just-in-time production, demand forecasting, and regular stock assessments. In conclusion, the concerns about inventory buildup on page 20 are a pressing issue that requires immediate attention from businesses and policymakers. By understanding the root causes of this problem and implementing targeted solutions, we can prevent supply chain disruptions and ensure a more efficient and resilient economy. That concludes the financial summary for Yum China Holdings Inc. Feel free to comment below, and I will be happy to answer them when possible.